than just business news, we're news for business people.
Good morning, you're watching All You Need to Know on Bloomberg Quint. I'm Darshan Mehta. Joining me on the show is Agam Vakil. Agam will speak about the FNOQs. I'll speak about the general trade setup, and it looks good at this point of time, at least on the equity side, because commodities are not doing well. But globally, global markets have recovered significantly. The SGX Nifty is indicating a gap-up opening of almost 130 points at this point of time. So expect a strong start from our markets when we open. The ADRs also reacted positively. ICICI to Dr. Reddy's anywhere between 3 to 5% gain is something that we saw. Some of the counters which didn't react that positively but still ended with a positive bias. HDFC, Wipro and Infosys up almost close to 0.5%. Now commodities, oil has been doing well. It's up almost 1% in trade. So WTI crude, you can see up closing in above the $64 barrel per mark, and Brent has actually again moved up above the $67 barrel per mark. So there seems to be traction that's coming in on oil after 3 days of drop that has come in. But base metals saw a big sell-off that happened yesterday. So aluminium and copper were down almost 1.5 to 2% each. Zinc and nickel were down over 2.5%. And lead and tin were down almost 1%. Now, COMEX copper is trading with a positive bias currently. It's up almost 1%. And even copper in Shanghai has managed to hold on. But apart from it, despite the rally that we've seen in equities, you can see zinc, aluminium and steel rebar in China, they are still trading with a negative bias. So that's the cue that's coming in from the commodity space. Again, because of the weakness that we've seen as far as the summer commodities is concerned, and the 2 days ago and yesterday, how we saw global equities behave, gold and silver seem to be doing well for itself. Now fund flows, FIs were big sellers in trade yesterday. They sold in significantly. They sold in 2,300 crores in the cash market. What was bought was DIs, which bought in 1,700 crores in the cash market. Nevertheless, both FIs and DIs for the month itself are net buyers. How did the markets react yesterday? Reacting from the lows of the day, but nevertheless, the Nifty ended down almost 170 points. More pain was seen on the small cap and the mid cap index. They were down almost anywhere between 1.5 to almost 3% in trade. Two sectors which took the big brunt yesterday. IT was down 2.5 to almost 3%, and Pharma continues to bleed. It was down 2%. Now the Nifty was down almost 168 points. What contributed? It was the heavyweights. Infosys, HDFC, TCS and ITC contributed mostly on the negative side. Bajaj Finance coming in to react and moved at the top of the day, moving to the day's high. But what are the FNOQs indicating, Agam?
Again, Darshan, we've seen some weakness, but according to the SGX Nifty, we're seeing a little bit of recovery expected, at least in the early half of the session, which means that we really didn't see too much with respect to changes in open interest for the Nifty futures. When it comes to the Nifty bank futures as well, again, not too much to speak for, just about 1.5% cuts with respect to open interest. The India VIX did surge. It moved up as much as 25% yesterday, about the mark of 20. But should we see a positive opening, we're likely to see India VIX come off, at least in the first half of the session. And the Nifty put call ratio surprisingly moved up by as much as 1.13, despite the fact that Nifty fell because it's usually correlated. Now, what we saw in terms of options was unwinding in 10,500 and 600 puts, and a little more writing in the 10,500 and 400 calls. That said, moving in, what are the stocks that we are watching out for? Gen Irrigation moves into the ban, expected restricted trade there. On the other hand, India Cements and Wockhardt moves out. We have seen fresh longs build in Mindtree, so watch out for that. On the other hand, we're also looking at fresh shorts building in something like a Grasim, where we saw about 11% increase in open interest. That said, once again, all eyes will continue to be on the index and whether or not we do see that impetus coming in from the global markets and see a recovery eventually.
Stock of the day is Gujarat Alkalis and Chemicals. The company has expected strong set of numbers for the December quarter. If you look at the top line growth, we're looking at a good 27% growth year-on-year basis at a number of around 618 odd crore as compared to nearly 486 crore that we've seen in the corresponding quarter of the previous year. If you look at the net profit, it's more than twofold jump there at a number of 112 crore as compared to nearly 47 crore in the December quarter. The operational efficiency too seems to be strong for this company. We've seen again a twofold jump there at a number of 180 odd crore as compared to 85 crore in the corresponding quarter. Margins have shot up to 29.1% as compared to nearly 17.5% seen earlier. What goes behind the making of these numbers will be your lower expenses, mainly in terms of your raw material cost and your other expenses, along with your higher revenue. Now, your raw material cost as a percent to your net sales, that cost has come down to nearly 27% as compared to 32% that we've seen earlier. Other expenses too have declined as a percent to your net sales to 11% from 15% that we've seen earlier. Also, in terms of the operational, besides the operational efficiency and decline in the finance cost has also aided the bottom line performance. Finance cost has nearly come down 20% on year-on-year basis for this company at a number of around 3.8 crore as compared to nearly 4.6 crore that we've seen in the corresponding quarter. That said, let's shift across to Saloni and Jayesh for commodity and currency market updates.
Well, talking about the commodity space, the LME base metal index declined as much as 1.7%, with most of the base metals on the lower end. A few reasons for the zinc actually going down about 2%, while the zinc cancelled warrants jumped about 19% to the highest level since November, and LME copper inventory fell about 2%, which was the most since December 1st. Aluminium and copper also declined more than 1% each, while lead and tin declined almost 1% each. As far as gold prices are concerned, gold actually fell to about 1325. A couple of reasons there. The rate concerns have come back into the market, and the dollar index has shown strength for 4 straight sessions now. As far as crude oil prices are concerned, we are seeing slight bit of uptick in early Asian hours after 3 days of fall. Now, API is likely to report an inventory decline of as much as 1 million barrels for last week. Also, EIA in the latest monthly report says that the crude oil output likely to jump above 11 million barrels per day will be sooner than anticipated. That said, Saloni Dhanuka is here to take us through the currency market update.
Thanks for that, Jayesh. Talking about rupee, it was following a global sell-off, also a sell-off in the local equities market amid strong US jobs data on Friday, and the rupee ended near 7-week low yesterday at 64.25 levels against the dollar. Now remember, the rupee did turn volatile during the day, and it touched an intraday low of 64.40 levels against the dollar. It ended lower for the 4th consecutive session. The home currency has depreciated by a good 66 paise in the last 4 trading sessions. Now, all eyes will be on the Reserve Bank of Policy meet, which is scheduled for today. The RBI is expected to maintain status quo at the 6th bi-monthly monetary policy meeting, while it may sound a little cautious on higher crude oil prices and fiscal slippages for the 3rd time in a row, which is post-budget. Moving on to bond market, yields on the benchmark 10-year security ended 3 basis points lower at 7.57%, while in terms of flows into debt market, global funds increased their rupee debt holdings for the 8th consecutive session yesterday. According to NSDL data, they infused close to 550 crores. Well, on the global front, the dollar index trades higher for the 4th consecutive session today, and it ended steady near 89.6 levels yesterday, giving up much of the gains of 0.4% gain during the day. The dollar retreated from highs on the back of widening trade deficit data and dovish comments from the Fed officials, wherein he said that he favors a low interest rates for an extended period on worries of higher inflation. And lastly, coming back home, dollar rupee is trading at 64.06 levels against the dollar in the non-deliverable forward market, which indicates a positive opening for Indian rupee in today's trade.
The Monetary Policy Committee meets for the last time this fiscal year and delivers its decision on Wednesday. The expectation across the board consensus view is that there will be no cut in interest rates. Why? Well, let's explain and look at the various aspects that will go into this time's decision. The first thing to take note of is what has happened to inflation over the last few months. Now, until about 3 months back, there was still some expectation that maybe there'll be one odd rate cut more from the MPC. But that expectation has dwindled, in fact, completely died down, because inflation has gone above the midpoint of 4%. In fact, in the last reading, inflation was above 5%. And over the June to December period, you've seen inflation normalize quite rapidly. But remember, the inflation targeting framework is a forward-looking framework, so the MPC will be more worried about what inflation looks like from here on. And there, if you lean upon the professional forecasters survey that the RBI puts out quarterly, even from that you get a sense that from here on, over the next 2 quarters, that is the current quarter and the 2 quarters after that, you will see inflation remain above the midpoint of 4%. And this is before we take into account the fact that global commodity prices have continued to rise between last policy and this policy, and oil in particular has continued to rise as well. That's the inflation story. There are various other elements that have gotten built into this since the budget, and particularly the fiscal deficit trend. Now remember, the government did not manage to meet its fiscal goal for FY18. You could forgive them that because of GST, but they're not intending to meet a 3% fiscal deficit target even in FY19 or FY20. They have now pushed back the 3% fiscal deficit target to FY21. Does that have a bearing on the MPC's ability to meet its 4% inflation target on a durable fashion? I think we'd like to hear particularly from Governor Urjit Patel on that, because in his inflation targeting report, or rather the monetary policy framework report of 2014, he had said that he would like to see the fiscal deficit brought down to 3%, which he thought was necessary and achievable. So we'll watch for the MPC's view on fiscal deficit and fiscal consolidation. We'll also watch for the MPC's view on the MSP story, the minimum support prices. Now in the budget, the government had said that for the Kharif crop, they will ensure 1.5 times production remuneration to farmers. Will that spark more inflation? Well, there are divided views on that. For instance, Bank of America Merrill Lynch does not believe this is going to be particularly inflationary. Nomura said that for every 1% increase in MSP, you could see 10 to 15 basis points added to the headline inflation number. And Sajid Chinoy of JP Morgan said that you have to watch how rapidly they do this, and in particular, you have to watch paddy to see what the headline impact is going to be of that MSP announcement. So that is another uncertainty that the MPC will have to weigh. The final thing that the MPC will have to weigh is what has happened to market interest rates, at least the bond market interest rates. Now yields have climbed up for a bunch of reasons: expectation of higher inflation, expectation of tighter monetary policy, and most importantly, expectation of fiscal slippage, which means that the gap between the repo rate and the 10-year rate is now 150 basis points. Will the MPC take note of that and the impact that could have on just a nascent recovery in the economic cycle? We'll watch for that. But remember, the last policy time when Urjit Patel was asked whether liquidity conditions were too tight and bond deals were cited as a reason for that question, Urjit Patel said that he is watching the call money market, which is the overnight bank lending rate, and that has been near the repo rate at 6%. So if he continues with that view, perhaps while the RBI will tackle the issue of higher market rates, they may not be in a mood to do anything about it, and do anything means commit perhaps to open market operations or easier liquidity conditions. So they will take note of that as well. One final thing, in the last few days, we've started to see global volatility as well pick up, and that certainly will be at the back of the mind of the MPC as they make this final decision of the current fiscal year.
Well, among the stocks that we are tracking today are some of the names which could react positively on the back of order wins. One of them is KC International, which has received an order worth 2,035 crores. You also have Bajaj Electricals, a smaller order win, but you could nevertheless see some positive reaction. They've won orders worth $4.1 million in Zambia. We're also looking at Praj Industries, which has received a letter of acceptance for an order worth about 17 crores. Again, not a very sizable one. But you also have McNally Bharat Engineering, again order wins of about 68 crores or so, so keep an eye out on all those names. The other part, Max Financial Services, will be in focus. The board will consider fundraising in its meeting on Friday to invest in its subsidiary Max Life Insurance for it to be able to pursue inorganic growth, so keep an eye out for that name. The other part, you also have Monet Ispat, which will be in focus. Now this is on the back of an ET report which says that JSW and Monet Ispat are close to a deal, and in fact an announcement could be expected within the next month or so. We're also watching out for Canfin Homes. Now this is on the back of a ET report which says that HDFC is exploring options to acquire a stake in Canfin Homes, so watch out for that name. Bharti Infratel could be in focus as well on the back of an ET report which says that Vodafone is in talks to sell its stake in Indus Towers to Bharti Infratel. So those are some of the stocks that you need to watch in trade today.
Okay, two pharma companies that will report numbers today. First of all, let's talk about Cipla. As far as the company's financials are concerned, we are seeing a 13% growth on Cipla as compared to a degrowth that we saw in Lupin. And the main reason is more India-focused business and less US-focused business at this point of time. So a 13% growth on the top line, a bottom line growth of almost 23%, and margin expansion to the tune of almost 20.3% versus 18.5% is something that we are anticipating. Let's take a look at the geographical breakup. And you can see that most traction will come in from the Indian markets, 15 to 20% growth. US will be 8 to 10%. South Africa close to anywhere between flat to 5%. Europe 40 to 50%, and rest of the world anywhere between 5 to 10%. Now, US business hasn't been that big for Cipla because they are the late entrants. But the new launches is something that will aid Cipla with their US business. Apart from it, they've gotten approvals for certain new drugs. So they've got approvals for Renvela, Dacogen, Pulmicort, as well as Pataday. So all these 4 drugs will aid Cipla in their US business. Domestic businesses will grow on the back of of a low base, and they're coming out of the GST quarter, and the low base was because of demonetization. And the company has been focusing significantly on efficiencies as far as operations is concerned, and that will aid margins for Cipla going ahead. Now, the next number that will come out in the pharma space will be Aurobindo Pharma. Even here, we are seeing growth of close to almost 9%. Profits will be up almost 14%, and margin improvement by the tune of almost 80 basis points to 23.7%. Now, they have 2 businesses, the API business and the formulation business. Both of them are expected to show growth this time around. As far as the US business is concerned, we are anticipating close to almost $300 million of sales that will come in. Nevertheless, there was some competition in some of the key drugs like pantoprazole as well as Renvela, and that will hurt the US business. But to offset this, they have had several new launches both in the US markets and European markets, and that will offset the losses in the drugs which have facing competition. They have a high share of injectable. The product mix will be favorable, and that is why we are seeing an improvement as far as their margins are concerned.
Some of the stocks to watch based on the delivery volume as of yesterday. First up, we have State Bank of India. It was down about 2% and saw delivery selling in excess of 550 crores. Delivery volume almost doubled at about 2 crore shares as compared to its 5-day average, and the total volume shot up 54% at about nearly 4 crore shares versus the 5-day average. Tata Motors, the second stock to watch out for, it was down about 5% after results. Saw delivery selling in excess of 400 crores, and delivery volume was up 110% at about 1.1 crore shares as compared to its 5-day average, and the total volume surged about 120% at about 2.7 crore shares as compared to its 5-day average. Last and final stock to watch out for would be United Breweries. It was down 4.5%, saw delivery selling in excess of 125%. Delivery volume was up about 3 times at nearly 11 lakh shares as compared to its 5-day average, and the total volume surged about 75% at nearly 16.5 lakh shares as compared to its 5-day average.
Today on Brokerages, we have Jefferies on engineering and construction sector. Now, they are saying that the sharp downside that we have seen in the last few days has given a good entry opportunities in engineering and construction stocks. Now, they're expecting a sizable capital expenditure announcement over the next 12 to 18 months, and then saying that the third quarter order inflows and the rise in budgetary inflow outlays are encouraging for these stocks. Now, their top picks are L&T, ABB, Voltas, and KIA Industries, while they have an underperform rating on BHEL and Thermax. However, when it comes to BL, they have upgraded the stock to buy from hold, but have maintained the target price at 190. Now, they're saying that the recent correction has provided a good entry opportunity in the stock, and they're expecting a double-digit revenue growth from the company going forward. Now, they're saying that the macro defense story is still in BL's favor, and they are positive on the stock on momentum and on company's momentum in order inflow and execution that we have seen in the last few years.
Historically, when you look at commodities, they perform very well during rate hiking cycles. It's kind of a tautology because it's the higher commodity prices that lead to the inflation that forces the hand of the central banks. But on average, the GSCI is up 19% per annum during rate hiking cycles. And we'd expect to see more of the same over the course of the coming years.
So rotate into industrial metals. That would be your call.
Absolutely. In fact, that during the rate hiking cycles, industrial metals are up on average 50% per annum. We did 30% last year. So we think again that in this type of environment, this is what commodities were intended to perform really well, and what we've seen so far is spot on.
Gold has only ticked up marginally over this market rout. Has it lost its safe haven status?
Historically, which is why gold is not a good hedge for inflation, is that when you see rate hikes, you typically see gold start to trend down. And it has to do with the fact that gold is negatively correlated with real interest rates. So I think about what gold is a hedge against debasement. So when the U.S. government prints a lot of dollars, as we saw in 2009, that typically puts downward pressure on real rates, which puts upward pressure on gold. The environment we're in right now is the Fed is raising rates. Now, historically, gold would go down. Why did it go up? It's the wealth factor in China right now. The demand out of Southeast Asia, in emerging markets more broadly for gold is unprecedented, which is putting a bid into gold in an environment which typically gold would trade down.
And you're saying you've got the wealth effect in Asia for gold. We don't have a lot of fear in developed markets. If that was to come back, some big geopolitical risk, then you'd have both wealth and fear. Where would that send gold?
We look at our new framework for dealing with gold, as you point out, it's fear and wealth. So our target right now with modest fear, and that's measured with your real interest rates, is 13.75 at the end of this year. So we've got modest upside embedded. But if you point out if situation geopolitically gets a lot more dangerous, the upside could push us up into the 1400s or even 1500.
Brent has been pretty much flat over the last few days. You're forecasting $80 a barrel within 6 months, right? How dependent is that on OPEC holding the line with its supply cuts?
Well, the core of the forecast revision really had to do with demand growth. It's well above expectations. In fact, I like to point out global GDP right now is tracking 5.1%. Our forecast is roughly around 4. Consensus is 3.7. So growth is far greater than expected. The other factor, as you point out, OPEC compliance was running as high as 140%. You put that together, the oil market rebalanced 6 months sooner than we anticipated, which is the core of why we raised our forecast. Now, the question, does OPEC come back into the market? The key here is demand growth rates compound. So the longer they wait, the more difficult it is for them to catch up to demand. And if they miss just by a few days, it's a problem. I'd like to point out, let's say I'm a refinery down in Singapore. I got 2 days of inventory sitting in my tanks. A refinery or a tanker from Saudi Arabia calls in and says it's going to be a week late. I am 5 days short. I have to go to the market and bid up the spot price for oil. So that timing is really critical. Strong demand environment, low inventories. This market has a lot of skew to the upside.